Sigmund from Seagull Training. Today I want to share with you how I tackle debits versus credits. Now over the years I did battle with the concept and I never knew which account should I debit and which one should I credit. All accounts have a debit side and a credit side, and in the old manual bookkeeping system the accounts got drawn on a page that looked like a T, so it had a line across the top and a line down the center. The left hand side was a debit and was traditionally written in black or blue, and the right hand side was a credit, and traditionally the color red came into play on that side, and hence I brought in those two colors to play out in the logic models. Pacchioli designed the double entry system, and I'm not going to go into that detail here, but just remember that all accounts have a debit and a credit side. Now here's the interesting thing, is in modern bookkeeping we actually only enter the one side. Why is that? Well, the software package is that intelligent that through our cross-referencing, it goes and enters the entry in the other account automatically. So when we capture a receipt in the cash book, we only see one side of the cash book account per se, or the general ledger account bank. So we're capturing in that one side only, and the accounting software package goes and puts an entry on the other side. So all entries in accounts, even though we're capturing one side, still have two sides, but we do not have to capture the second side. That's a time saver. Do not get confused because you are only putting in one side of an entry. This is the same rule that applies to when we're capturing debtors, when we're capturing creditors, when we're capturing fixed assets. We put in the one side and the account captures the other. However, there are journals where the accounting software package doesn't know what is the other side of your entry. Which account must it automatically use? And those journals, we put in both sides of the entry. So we put in the two accounts that are affected in that transaction. In manual bookkeeping, we had to do both entries. In this lesson, I'm going to help you remember when to debit accounts and when to credit accounts. Now there are various methods. There's the old rule of thumb which said debit the receiver and credit the giver, but which to me didn't always make sense in every scenario. Then there's the rule of thumb that used the mnemonic dead click, which said debit expenses, assets and drawings, and credit liabilities, income and capital. I found it a little bit difficult to remember the mnemonic in the beginning. Yes, I had to learn and repeat it and repeat it and repeat it. But something I did realize is that my logic models showed me which accounts to debit and which accounts to credit. And I had a mind map which bolstered my understanding of dead click, and I found it easy to remember. And if I couldn't remember if something is an asset or a liability, I would go back to my mind map and say, where would it fit in this business picture? Somebody taught me the rule of always debit the receiver and credit the giver. So if you're buying an asset, for instance, then debit the asset account because that is where it's being received, and credit the supplier account. Now that made some sense to me. But then I got confused. When I was in the balance sheet it was easy, but when I got to expenses I wasn't quite sure, because debit the receiver is the expense receiver. I wasn't quite sure. Now in the bank, when I pay, I'm giving. So the bank I saw in my mind's eye was giving. However, what confused me is when you got the statement from the bank, it seemed to be on the opposite sides. Now why is that? Well, the bank is giving you a reflection in your statement. They're giving you a reflection of your account in their books. So don't look to the bank account for guidance. Or if you do, remember that that is a reflection of their books. So your books should show the opposite. So when the bank receives, you debit it, and when you pay, you credit it. So that worked for me. A few years later, I learned the mnemonic dead click. What dead click stands for is the dead side says debit, expenses, assets and drawings. So those letters, debit, expenses, assets and drawings. And then on the credit side, it said credit. The following: credit, which is a C, liabilities, income and capital. So that helped me understand the concept a little bit better. So let us start with these models. I'm going to start off with the working capital model. So if you recall in our logic models, when I went through the simple business and we grew the business model, I showed you the picture of the working capital. This working capital formed the heartbeat of the balance sheet logic model. And if you recall, the balance sheet logic model looked like this. Now, I said at the time when we went through the balance sheet logic model, is if we drew a diagonal line through the model, then we would divide the model into items the business owes, or people or third parties that the business owes money to, and then items that the business owns, or assets. We commonly refer to those as assets. Now, I colored them in blue and pink so that you could observe and understand them. So this working capital model that we had there formed part of our balance sheet logic model. And you can see the area that it covered. So the working capital was those items that the business bought and sold or traded in. The fixed assets are those items that the business bought to utilize in creating its product, whether that be computers or whether it be machinery or whether it be vehicles. Those are all fixed assets. So it didn't buy those items to trade with it, but it's items the business owns. On the other hand, the business owed money to various third parties. So it had liabilities or debts, and those are to the owner. Retained income is the profits that is still owed to the owner. And we went through that at one point. So your long-term liabilities are the loans. That is the money that the business borrowed from a third party so that the business could continue with its daily operations. Whether that was to buy an asset or to buy raw materials is really immaterial to the business. It was money that it required to operate with. And then we had the suppliers. So those are the short-term creditors or the short-term debts that the business owes, sometimes known as the current liabilities, current being short-term, another word for short-term. So the current liabilities are the suppliers that the business owes money to in its day-to-day operations. Now that balance sheet logic model, I said if we drew a line diagonally through it and divided the red half from the blue half, we would then see all the items that the business owns and all the items that the business owes. So all the items it owns are its assets, and all the items it owes money to are its liabilities. Now this was what formed the balance sheet report. And here's the simplicity of debits and credits. Debits are all the blue items. Now if you go back to your mnemonic, you said debit, assets. Do you see? Assets are debited. And liabilities, we credit from the mnemonic. Credit, liabilities, all these red items. So I found that when I was sitting in a dilemma of should I be debiting this account or should I be crediting this account, I started to refer to this mind map. And I said, is this something the business owns or is it something the business owes to somebody? And the minute I knew that, well, then I could see It needed to fit in here somewhere. The reservoir fitted in here somewhere. And that is how I came to remember the balance sheet items. Anything we own or the business owns or is an asset, we debit. Finished. It's a blue. Now something that's interesting. That cash reservoir I made very big because sometimes the cash is overdrawn in the bank. So sometimes that bank account falls on the red side and sometimes it falls on the blue side. This is something that happens in most modern businesses. You have a bank account and you can overdraw it. So the bank gives you a facility which says you may go into the red in our bank account and therefore it would belong to the side you owe money to. So don't get too phased about it dividing the cash. If you have cash, it's an asset. If you owe the money to the bank, it's a liability. So that to me was a very, very easy way to remember this formula and what to debit and credit. So let us take this concept a little bit further. Let us look at the income statement. When we look at the income statement logic model, we see the following. We see all the items, and I explained that to you, that are expenses. Items that occur during the business that seem to suck the money out of the business, away from the business on a permanent basis. So when we pay labor, the business receives the fruits of that labor. So our workers do work for the business, but the money that is consumed to pay them to do that work is lost to the business forever. So that cash disappears. Similarly, we have expenses like electricity. We buy electricity. Yes, the business gets the electricity. So it gave money for that electricity. But that electricity didn't become part of our end product. We didn't sell the electricity. It got lost and it got consumed, so it's an expense. Now, according to the mnemonic, all the expenses are debited and all the receipts are credited. So all the income, everything the business receives is credited. So now one has to understand this. Where does it receive money? Well, firstly, it receives money when we make a sale. That money from the sale is received into the cash reservoir. So it comes into the cash reservoir. Similarly, our suppliers might give us a discount. So because we settled the account early, they gave us a settlement discount. And they said, thank you for settling the account. We're going to give you a discount. You don't have to pay me as much. And therefore, in effect, the business received income in that area. The bank might give the business interest, so it might pay interest to the business. So that would be a receipt. And in this logic model, all the receipts or all the income are colored in orange. So all the orange coming in is actual receipts. All the expenses are either colored in blue or else they're colored in purple, where it isn't a real cash movement. So when we create a provision for a bad debt, for instance, there's no cash that changed hands. It's a calculation. As an accountant, we did this calculation and we decided that we need to keep aside from our income a certain amount of money because we're not going to receive all the monies back from the customers. So a bad debt provision is not a cash flow. There's no money that exchanges hands. Similarly, there's no money that exchanges hands in depreciation. Nobody receives some money and puts it away for a rainy day. In that situation, we are actually theoretically or virtually putting aside money. But in actuality, we haven't put aside any money whatsoever. This is important to remember. So all the outflows are expenses, and all of those must be debited, and all inflows must be credited. Now this didn't fit quite well with my first rule, which was debit the receiver and credit the giver, because I'm sitting and saying, well, the income I'm receiving, so why aren't I crediting that? Well, here's the key, and this came to me through these logic models. What is the net effect of all my income and my expenses? It's profit. If my income is more than my expenses, it is profit. If my income is less than my expenses, it obviously is a loss. But that net effect, when we've calculated that, what does that affect in my balance sheet? It ultimately affects retained income. If I've made a profit, I keep retained income, or I increase retained income. If I've made a loss, I decrease retained income. So the reality is this, that whatever that income less expenses equates to, the profit or the loss actually affects who? It does affect the business, but in an accounting equation, it affects the owner's equity or the owner's claim on that business. So the net effect of that must equal a red. If it increases, it must be red, because it's going to change the retained income or that reservoir around the equity. So now it makes total sense to me. All the assets are in blue. All the items I owe or the business owes to third party are red. Therefore, the net effect of the income statement or the income and expenses must be red. That is why income, because it's going to raise what we owe to the owner, is credited. And that is why expenses, which is going to lower the amount of profit, are debited. Now, the last part of that mnemonic was the D at the end, which said drawings. Now, all drawings are an expense to the business. It is money that the owner has taken out of the business for himself or herself. So that is money that has been paid. Therefore, drawings reduces the owner's equity. And owner's equity is red. So if we reduce it, it's blue. But to me, it was quite easy. Whether I'm paying somebody a salary or I'm paying the owner some money in the form of a salary or drawings or because he took some stock, all of those are an expense to the business. So it's as simple as E. E and D are the same meaning, excepting we just differentiating between what went to the owner versus what went to other people. I hope that this mind map will help you remember debits and credits better. It certainly did it for me.